So by far and away, the number one reason why companies go bankrupt and why their stocks go to zero and why their investors lose a lot of money is without a doubt leverage. And in my mind, there are two types of leverage. There's the one which everyone talks about all the time, which is debt. And they talk about it for very good reason, because it can certainly kill a company if it's not managed well or if it's there in large amounts. But the second type of leverage that not many people talk about, or not enough people talk about in my opinion, is operational leverage within the business itself. So I want to spend a bit of time talking on both of those topics, and that should hopefully give you some insights on how to think about different types of businesses and their potential to go from earning reasonable profits to losing a lot of money very quickly and having things head south, which you obviously don't want as an investor, regardless of how long term you are. You know, even if you're buying stocks cheap when they go down, you don't want them to go to zero. So let's get into that. I hope you enjoyed the video. If you do, hit like, hit subscribe. This is my second attempt filming it, because I filmed it the first time around and like half the video was out of focus. So I hope you enjoy. Let's get into it. So the first type of leverage is debt. And like I said, people talk about this a lot for very good reason. It can certainly kill a company. And there's a few things that I like to watch out for. So first off, my perfect amount of debt for a company to have, generally speaking, is zero. If they have zero debt, they're very unlikely, obviously, to go bankrupt. And that's an actual probably underutilized Peter Lynch quote, that a company cannot go bankrupt if it has no debt, and people tend to forget that quite often. So there's great companies out there that have no debt, and that is the ideal kind of positioning I want to see on a balance sheet. That doesn't mean I won't invest in companies that have debt. It just means that we have to be a little bit more careful. So you'll see investors like Phil Town, for example, use a few rules of thumb around not investing in companies that have more than, say, 3 years earnings in debt. But it varies with different businesses. You really have to understand the thing inside out, understand the risks, operational risks that can turn the business negative in terms of its cash flows and grow that debt pile very, very quickly, or even get it into the position where it can't pay those debt obligations. So there's a few things to watch out for there, and one of the ways that debt can get companies into a lot of trouble is in situations like right now. So a classic example of this would be something like the cruise line stocks. The cruise line stocks have been raising capital in a couple of different ways. So firstly, they already had a reasonable amount of just your standard corporate debt. We pay an interest rate on that debt, and after a certain period of time, the balance of that debt is often due. So often you'll see companies have to make lump sum payments on debt. And one of the really bad things about being in that situation when economic times are good is that when economic times get bad and cash flows go negative and you get really desperate for cash, you have to do some quite desperate things that can hurt shareholders. So one of the things that Carnival Cruise Lines, for example, have done recently is they have issued new shares. So they've sold more shares, they've cut the sort of overall pie of the company into more slices. They've sold those to investors in order to raise capital, get their hands on some more cash, and avoid going bankrupt, essentially. So the reason that's bad is that they've had to do this at really, really low prices compared to where their stock has been in the past. So their stock is down something like 80 or 90%. It may have bounced up a little bit now, but it was down very, very dramatically, still is down a lot. And they've issued shares at these very, very cheap prices. If you're ever going to issue shares, you want to do it at high prices. When your stock is overvalued and the market is paying more than the intrinsic value of the business for that stock, that's when you would happily issue more if you're a very rational thinker in terms of your capital allocation. And a lot of capital intensive businesses generally have gotten themselves into this position where they already have a lot of debt and they're really, really short on options to get money into the business to avoid it going to zero. So that's the first type of leverage that you'll definitely need to watch out for. So let's talk about the second type of leverage, which is operational leverage. Now, operational leverage is something that, in my personal opinion, definitely does not get enough attention. So first I'll talk through what it is, and then I'll give you some examples on how it can hurt companies as well. So basically, operational leverage applies to generally businesses that are very capital intensive. So you're talking your airlines, your car companies, your cruise liners, anything where you have to lay out a lot of money to get that business up and running. In anything where also you tend to make quite thin margins and have very high fixed costs. So if I give you the car company example, if we look at a business like Ford, they obviously run very, very efficient factories when they're sort of firing on all cylinders to produce vehicles. And in a good year, if we take 2018, for example, as a good year for Ford, they produced something like $160 billion in revenue, which is a bucket load of money. Now, where the problem comes in with Ford specifically is they only kept about $3 billion. I'll put the exact numbers on the screen here somewhere, but they only kept about $3 billion of that $160 billion in earnings. And those are very thin margins. And one of the issues you have with a company like Ford with a lot of infrastructure and a lot of fixed costs is that those margins can go from thin to zero and negative very, very quickly. So if you look at a business like Facebook or Google or a company like that where they're selling sort of software as a service, they don't have a lot of fixed costs. So they typically have very, very high margins. A lot of their revenue is going to the bottom line. And if they have a drop in revenue, sure, it can hurt their profitability in the short term, but it's generally not going to kill the company. And even in really, really bad years, they can still actually make money on that decreased revenue. Now, when you look at the car companies and look at someone like Ford, let's just say hypothetically they went from 160 billion in revenue to 150 billion in revenue. That is roughly about an 8% decrease, I think. With a lot of companies, you'd see probably about an 8% decrease in their earnings power as well. But what you're more likely to see with a business like Ford is they've got all of these fixed costs and they're really only keeping those last kind of few billion in revenue as earnings. So if you have an 8% or $10 billion decrease in revenue, rather than seeing an 8% decrease in that $3 billion in earnings and dropping you down to, I don't know, maybe 2.8 billion in earnings, what you'll actually tend to see is more like that $10 billion figure. So all of a sudden you can go from earning $3 billion to earning something like negative $7 billion because you've still got all those costs and you're not really getting a lot of those profits until that kind of very last kind of top end of revenue that's coming into the company. There are certainly costs you can cut out in leaner years and that sort of thing. But nonetheless, you can go from being relatively profitable to being an absolute money pit, losing a lot of cash very, very quickly. And we saw a little bit of that in the first quarter results for some of these companies that have just come out. The first quarter included a couple of pretty good months, and it included the first month of the current crisis that's going on. Factories were shut. And that is not good for car companies. So things turned south quite a bit in that situation. The good thing is when you don't, actually run a factory, you can save a lot of money. So you're obviously not using raw materials. You're not employing as many people as you did. So you can cut some costs there. Where I think these companies are really going to hurt personally, and I think we'll probably see this in the Q2 results when they come out, is with the auto companies specifically. We're seeing a lot of businesses start to reopen factories, but the factories are running nowhere near as efficiently as they were before. So they're having to slow down rates of production in order to ensure social distancing. So these businesses still basically have all of their manufacturing costs. They still have most of the labor that they would have had when they were running at full steam. They've maybe got a little bit less raw material costs because they're not producing at as fast a rate. But nonetheless, that is a big recipe for squeezing margins having even higher costs without bringing in all of the revenue, because you're not having as much productivity come out of those factories. And I expect that in companies where they've got a lot of capital expenditure and they're running these type of slower production, less efficient type factories, we're probably going to see a lot of negative cash flow over the next couple of quarters. So that's a bit on operational leverage, and that's kind of the way I think about it. In terms of what it means for the business at the end of the day, it means that they can kind of wipe out a lot of years of hard work very, very quickly. So if we again keep picking on Ford, and I'm sorry if anyone's a Ford shareholder here, but it's a nice example to kind of walk through. So if we assume that Ford earns maybe $2 to $3 billion a year in free cash flows when times are good, and let's say they have 5 years of good times, so they earn something like $10 to $15 billion in free cash flow over that period of time. What can happen is the company will get very excited about that. They will pay a lot of dividends. Unfortunately, they haven't paid off a lot of debt through that time. So they're paying off a lot of dividends. Their balance sheet remains fairly fragile, to be frank. And they're paying out all this cash when times are good. And all of a sudden, they've got very little cash. They've still got a lot of debt, but the shareholders are pretty happy because they've had a bunch of dividends. So they've earned something like $10 to $15 billion over that period of time. What can happen is if we have something like is happening at the moment, they can go from earning $10 to $15 billion over 5 years to losing something like 5 to 10 to 15 billion, depending on how bad things turn out to have been, in 1 year. And that wipes out a lot of shareholder value very quickly, and that's the reason that often it's these very capital intensive businesses that are the first ones to go bankrupt. So that's some thoughts on leverage. It's definitely the number one reason that businesses go to zero and companies have a lot of issues, and shareholders are obviously very much hurt by that. Two types of leverage: straight up debt and operational leverage. Everyone talks about the first one. No one seems to talk about the second one, but hopefully that gives you a good overview of both. So hope you enjoyed the video. If you did, hit like, hit subscribe, and I will see you in the next one. Cheers.